Welcome to a Monday edition, Monday of Thanksgiving week. For those who don't know or don't recall, this is Thanksgiving week in the U.S. This is a holiday-shortened trading week, at least for U.S. traders. And, of course, you could argue that, the liquidity gets notably thinner on this Thursday and Friday of Thanksgiving week, so keep that in mind. And welcome to the latest rendition of my webinars at Epic Street. As always, thank you very much to everyone at Epic Street for making this event possible. And thanks to each one of you for your attendance and your attention and your participation, and for every once in a while asking challenge me with your questions. And I do enjoy the challenge. So let's get started. First of all, let me remind you the purpose of this event is education. I do not provide specific trade alerts or recommendations, but I will take a look back at training data that is now in the books, and we'll take maybe a peek ahead at what tomorrow might bring as well. Maybe it's just me, but you know what? I was going to jump to what I consider one of the key trades of the day. But while I'm thinking about this, I have to show you this. I'm looking at a 15-minute chart without indicators for S&P futures. So this is the front month futures contract for the S&P 500 index. Front month futures contract, S&P 500 index. So stock futures, essentially. Well, see, you saw the drop down earlier today, and we've been sort of stagnating, sort of consolidating after that move earlier today. Oh, you don't see my cursor. Hang on. So we got a leg down in early European trading and a continuation during today's New York morning session. Well, I want to bring your attention to that Euro move we talked about earlier. Yeah, Dan, I see a comment about the ECB. That's one of the theories being espoused by Zero Hedge. Maybe if you're looking for a theory, I'd rather like that if there's a theory behind that move, I'd rather prefer the one that's involving say French banks rapidly selling U.S. dollar assets and the idea of repatriating the dollars and converting the dollars they receive for those assets in the euros. That, to me, that one makes a little more sense than an actual intervention by the ECB. I don't think we're there yet. Although, you know what, I suppose, and if it is happening, they're going to they would probably announce such or I don't know. It doesn't seem right to me. I'm trying to think, what would help the eurozone. And I don't think it's going to be, why would the ECB be buying euros? I'm thinking a lot on that. It doesn't make sense to me. If anything, the southern peripheral, I need to add this chart here. The Eurozone countries in the southern periphery who've been undergoing some challenges these days, if anything, they need a weaker euro. Unless you have the ECB intervening on the prospect of eventually the euro is just going to flat out tank. But yeah, the intervention theory just doesn't sit right with me. Yeah, here's the chart I wanted to show here. I'm showing the darker colored candles. The thicker darker colored candles are for the S&P futures, as I mentioned a moment ago. The lighter colored candles, which are also thinner, those are for the Euro-USD currency pair. Now, let me take off the auto scroll option here. I was hoping this chart would reset here, but maybe it won't. Oh, shoot, the candles won't reset. Well, the point I was going to make was this: we saw some general correlation between the two, between S&P futures and the Euro-USD, as is pretty customary. As the idea was they kind of move in lockstep. Stock futures like the S&P futures down, euro down, and one up, one goes up, the other goes up. And it's debatable who leads who. I find it notable that a lot of financial markets, stocks, bonds, I'm hearing a lot of traders in other financial markets refer to watching the euro. And yet we have some traders and even a coach or two at FX Bootcamp referring to watching the equity markets. So, go figure. Sometimes you got to wonder who's watching who. I tend to be leaning them in the camp that the the other financial markets are taking lead from the euro more than the latter, but that's just my humble opinion. But anyway, if you look at the movement in the euro USD versus S&P futures, generally they moved in lockstep up until the point we got that spike up in the euro today, and this was during the latter part of the New York morning session, not too long before noon New York time. So, whatever it was that moved the euro, it didn't have a corresponding effect, a risk-on effect, so to speak, on the likes of either S&P futures or even the bond markets, for example. If the rise in the euro were a symptom symptom, I guess is the right word, of a broad new risk-on mood, you'd see equities rise, you see bond prices drop and bond yields rise. And I'm looking right now on the U.S. 10-year yield. It's still below 2%, and it's been below 2% much of the trading day. So again, if we're looking for cause and effect, it's debatable. Who knows what's caused that euro spike earlier today. I mean, sometimes seemingly inexplicable moves do happen. As always, I do check for news flow to see if there's any assignable causes for something like that. But I frankly don't see any. I'm going to put this chart back to size. And delete the indicator. By the way, that's an overlaid indicator I added to that chart. Pretty slick little tool, I think. And many of you guys already asked about that before. If you have questions about where to find an indicator, let me know. Hello, Ren from Amsterdam. So here's what we talked about today. As I took my charge from our London session coach, Kristen Stevens, at about 6 a.m. New York time today, this was a little more than 7 hours ago, something he discussed and I noticed as well, and in fact, we weren't the only two that noticed. I mean, we had several traders in our live trading room talking about this. We got a sense that there was broad weakness in the commodity currencies. I'm talking about the Australian dollar, the Canadian dollar, the New Zealand dollar. The commodity currencies seem to be under pressure today. In fact, the one exception, let me go to my view of the yen crosses here. By the way, I look at the yen crosses, like the Aussie yen, the CAD yen, the Euro yen, the pound yen. I look at these pairs to get a sense of relative strength and weakness. Not that this is the only way to do it, but this is one quick glance way that I use to assess the relative strength or weakness of the so-called base currencies. In this case, I'm looking at the Australian dollar, the Canadian dollar, the euro, and the British pound. They're all the first currencies in these currency pairs. And what I look for is it's sort of a game of which chart is different. Now, in today's case, I must say it was a pretty broad, pretty consistent theme. These charts, I believe, are shown at about 6 a.m. New York time. Maybe mistaken, but I'm pretty sure these charts are all shown at about 6 a.m. New York time, maybe off by a candle or two. These are all hourly charts for 4 major yen crosses. And you can see that the Aussie yen, the CAD yen, the pound yen, all down today. What struck me is that after an initial euro sell-off across the board in early London session trading today, the euro yen never did make a new low for the day, at least during the greater part of our London session today. So that was notable that while the other yen crosses had proceeded lower, and again we saw some signs of commodity currencies being weak, Aussie down, CAD down, and such. Not the euro. So if there's one thing we concluded today, at least from price action up to this point in the trading day, up until about 6 a.m. New York time, about midway through the London trading day, there's one thing we concluded is that some selling pressure on the commodity currencies, and the euro, at least over the 3 or 4 hours leading up to 6 a.m. New York time today, during much of the London session after the initial sell-off, the euro had held up pretty well. The euro was rather firm. So what we talked about was during my London coaching session today, starting at 6 a.m. New York time, we talked about the opportunities to sell the commodity currencies. And by the way, what I haven't mentioned up to this point was that we already had at this point in the day a broad risk-off mood, especially if you looked at the major European equity market indexes. The DAX was down. That's Germany's main blue chip stock market index. The DAX was down. The CAC 40, that's the main French stock market index, that was down. The FTSE 100 in the UK was down. We had some yields in Europe that were up. The government yields, I'm talking about like Spain and Italy, were up a bit. Not Italy as much, but especially Spain was up earlier today. So you had just the classic scenario of risk-off mood, and that often leads to either you buy the dollar or you buy the yen, or you look to sell the commodity currencies. The commodity currencies are are some of the major currencies that tend to be most sensitive to a risk-on, risk-off mood. Now, as many of you know, I've been talking about the Euro USD quite a bit in recent weeks, and as it moves, I'll continue to do so. But right or wrong, I'll show you the Euro charts in a moment. When the Euro's just not moving, the Euro's not moving, and when it's behaving like it did during today's London session, I tend to leave it alone and look for something else to trade. Yeah, Damon, I see you comment about falling oil prices. Oil has been dropping of late. There was the notable divergence recently between oil and a lot of other markets, and you didn't think it could last, especially given signs of a falling demand in Asia. But anyway, let me get back to my charts here with my market overview. Well, Solomon, I just offered some of the clues there. You look at the major European equity market indexes. And actually, there's a site. Let me open this up. Going to a website. It's actually the Financial Times website. I haven't checked this without being logged in as a member. As a subscriber to the Financial Times. I will do so now. Well, actually, I can't do that. I can't do that now, but let me walk you through this. Unfortunately, I think on this web browser I'm about to show you, I'm probably logged in as a subscriber. But here's what I check, Solomon. And by the way, there's other places you can check this, but I like this. What I'm about to show you, I like as a kind of a singular view of the major European equity market indexes. I go to ft.com. ft.com, saying that's the Financial Times website. And by the way, any one of you have other alternatives to recommend, similar to what I'm about to show you now, feel free to recommend those things, and including FX Street. At FX Street, if you've got something to offer along these lines, in fact, I'd love to know this, because there's some things I like about the Financial Times, what I'm about to show you, and there's other things I don't like about it. So anyway, I go to the Financial Times website, and they offer a graphic under the markets. So I've got my cursor next to the markets subheading here. I click on the drop-down window, and I select markets data. So yeah, so Janomics is Yahoo Finance, certainly another option. Well, let me show you this graphic. It's called the Global Macro Map provided by the Financial Times. It's a pretty simple single glance way to assess the European equity markets. So I go to markets data, and then I go to markets macro map. See the link I'm hovering next to now? Markets macro map. Again, it's called Markets macro map, and it's currently in the middle of this web page you're seeing now. So if I click on Markets macro map, you're going to see a little sort of an interactive graphic pop up. And actually, I'm hoping somebody can confirm this for me, because I am a subscriber to the Financial Times, so I know I get access to a lot of things on the Financial Times website that non-subscribers do not. What I don't know, and I haven't checked. I obviously haven't checked if as a non-subscriber I would have access to this or not. So if anyone cares to go through a little exercise there and see if they can retrace my steps and get to this point. And if you're not a subscriber, I think you can, but I haven't done it so long, I don't know. Okay, thank you, George. George has confirmed you can as a non-subscriber. Thank you. So Solomon, this is one thing I look at. Now, Solomon, I must warn you and everyone else, this is not real-time data. I repeat, this is not real-time data. But I'll check this especially at the start of like a news session. and periodically every 30 minutes or 60 minutes or so, I'll look at the broad risk on. And needless to say, when it comes to a risk off mood, the more red you see in Europe, the bigger the rectangles are, the steeper the sell-off, and the more likely we'll see things like dollar strength, or like Japanese yen strength, or weakness in the commodity currencies. And again, today was an exception, but oftentimes we'll see just the Euro USD dropping. So yeah, Dan's right. It's delayed at least 15 minutes. So what do I do? And this will take me back to my my view of multiple pairs and multiple financial markets. I'll show you in a moment. I tend to focus on one of these. I'll vary from day to day, but by and large, I will tend to focus on the DAX. The DAX is the main blue chip stock market index for Germany, and Germany is arguably the core of Europe. It's been referred to Germany as part of the core of Europe, strongest economy in Europe. And so I by and large, I figure as the DAX goes, so goes the other markets. And that is the currencies, for example. And I figure DAX is a pretty good indicator of Europe. Now, is it the only one? Is it always the best one? Absolutely not. There's other things that I do watch to get a sense of what other parts of Europe are doing. But if you're looking for a single thing, a single stock index in Europe to watch, I tend to watch the DAX as much as anything else, if only because there is some pretty solid correlation between the DAX or has been historically some decent correlation between the DAX and the Euro USD as an example. So let's get rid of this. Now I have I'm showing an FX Pro platform. This is a free demo account, which includes again futures. And I'm showing in the lower left-hand portion the S&P futures, but I've also got a symbol for DAX futures, and there's DAX futures. So again, it's not perfect. It's not a solid, repeatable, consistent correlation between DAX futures and the Euro USD, but the correlation has worked often enough lately that I find it worth watching. So risk on versus risk off. Checking European equities. I mean, the case, especially like earlier this year and in years past, we've been watching more U.S. equities, but for reasons I hope that are obvious to at least some of you. I mean, the market's focus, right or wrong, has been Europe. I mean, macro issues in Europe have been so key to influencing movements not just in European equities, but even U.S. equities. So hence my focus on Europe and European equities, and particularly the DAX. Now, what are the things do I watch, Solomon? Since you're asking about this, we've talked in these webinars from time to time about watching yields in certain European countries. That's government bond yields. For example, the 10-year government bond is considered a benchmark bond for most governments actually. So if you look at we've been looking at things like the Italian 10-year, the Spanish 10-year, particularly the Spanish 10-year of late. Spain's yields have spiked up in recent trading days. And for those, actually, someone that has it available to them could queue up a link. Actually, I can do this real quick. Here's what I do. I don't even memorize the link, but I've got it saved in my web browser. But here's what I do. I go to google.com. Or especially I do this if I happen to be on a PC that doesn't have this, but I don't have these web pages benchmarked. A simple Google search. Let's say we're looking for the Spanish 10-year yield. Spain 10-year yield Bloomberg. This is exactly what I do if I'm looking for the web page that tracks the 10-year for Spain. And one of the first search results you can already tell I've been here lately. Spanish government generic bonds. Mike, I don't on this web browser, but I do on other browsers. Honestly, I'm using Google Chrome right now, and I don't use Google Chrome that much. I usually use Fox. I'm a Firefox guy, but for one reason I don't have Firefox fired up right now. But Mike, I want to go through this exercise anyway because this is it's right. Google Chrome. It doesn't show this. When I show this in Google Chrome, the what Bloomberg page looks different than it does in Firefox. I actually don't like it as much here, but you can still get the reading though. You can still get the number here. So anyway, there's a link, for example, to take you to a web page provided by Bloomberg for the Spanish 10-year yield. And like the data that I just showed you on the Financial Times for the global macro map, showing the rectangles representing the different European equity market indexes. This is time delayed. This is not real time. However, I still find it helpful. One simple way I use this. Notice, for example, the high and low for the day. Actually, notice three things here. I'm looking at Spain's 10-year government bond yield, and these are a little deceiving, by the way. The green numbers here, don't pay attention to those. That's actually showing this 2.73%. That's actually the percent change in the yield. The percent change today in the yield. I don't care about. I guess it's okay to watch that, but here's what I focus on. I focus on the yield itself. And as of about 15 or 20 minutes ago, it was 6.55%. Now, what's notable about that, at least today, and it's something obviously worth watching tomorrow. Look at the high and low for today. So here's the kind of things I pay attention to when I'm assessing risk on or risk off. I'll check the yield on the Spanish 10-year, for example, and I may see that. Let's say I was checking this at the open of the New York morning session, 8 a.m. New York time. I see the yield on Spain's 10-year government bond at about 6.55%. I look at the high and low for the day. I see the high for the day about 6.59%. The low for the day is 6.36%. Now, what does that tell me? Which way are yields moving today? They're moving up. So considering the range of the day for the Spanish 10-year at that time, the yield is on the upper end of that range, and I'm guessing they're likely moving up. So what does that tell me? Does that tell me is that a euro positive or a euro negative? That is a euro negative. Now again, it's one of those warning signs. It's not perfect. What you do not do, and maybe I'm telling you more than I should. You do not just blindly sell the euro when you see the Spanish 10-year yield spiking higher. It is a clue, though. It is a clue. Yeah, Mike, I think you're right about all the Bloomberg charts. But again, these are tools that I still use in my own trading, and I admit I don't have access to real-time data on this, but frankly, I don't feel like I need it, especially considering that when it comes to the bond markets. The bond markets I have found lead the currency markets by enough. The bond markets in Europe have led, as I've seen it, the currency markets by not just minutes, but sometimes by hours, by days. Folks, I'm telling you, by days sometimes the bond markets lead the currency markets. But now on some days when we've seen the bond markets, it's like, for example, it was a couple weeks ago when the Italian 10-year spiked higher. And when you see when yields in Italy or Spain spiking high and doing so fast, yes, then the euro can turn south and really turn south fast. So, but again, bond yields are just one of the things I watch to get a sense of risk on or risk off mood. Hey, thank you, Mike, for that post there, for that link there. Hey, Damon, I don't do a lot of analysis on the S&P. I'll look at it just like I'll look at any other chart. But in terms of what the S&P is going to do, the one thing that strikes me is that, two things to consider. One is I'm sure there's more than a few hedge funds and even U.S. money managers, U.S. mutual fund managers who would like to see the market go up and have tried to pitch in to help lift the market up. So many hedge funds, for example, have underperformed this year. So hedge fund underperformance may more than anything else give the market a lift. Having said that, if things get nasty quick in Europe, all bets are off. All bets are off when it comes to a sort of a Santa Claus rally this year. Well, I realize it's almost 1:30 p.m. New York time. We've almost gone 30 minutes into my webinar. I don't want to ignore the rest of the questions, but I do want to get to one of the so-called feature trades of the day we discussed in my live class at FX Bootcamp today. So let me cue that up. Actually, let me. I was going to show it on one of these charts, but I'm going to go into my dollar CAD view. Michael, yes, I've discussed that, and that's a very valid point. Very valid point. I was going to get to that after I discussed this trade on the CAD. So here's what we looked at on dollar CAD today. We talked about some signs that commodity currencies were under selling pressure, and let me adjust this chart for a minute. Here's what we are facing today. I mean, it's been a virtual ride to 5 scenario here on dollar CAD. The upper sloping maroon colored line on this 15-minute chart, that's the 5 EMA. When you see, oftentimes when you see just a steady, in this case, a steady rally, I mean, no huge candles, but just steady buying, you'll get a ride to 5 situation on actually multiple time frames. Arguably, we have that to some extent even on the daily chart right now. But anyway, a ride to 5, 15-minute chart, dollar CAD. Every valid reason considering the risk-off move we discussed earlier to seek to buy this currency pair. So again, dollar strength common when the mood is risk-off, and we've seen evidence of the Canadian dollar being weak, not just against the dollar, but also against the yen. And there's a couple of other currencies, other major currencies where the Canadian dollar was at least a little bit on the weak side compared to those other major currencies. So anyway, we were talking about seeking an opportunity to buy this currency pair during my coaching session today. And to assess that, I was talking about, I was looking at a 5-minute chart. Let me go to that now. By the way, nothing magical about a 5-minute chart. What we did was, what I wanted to do is I wanted to look at a 5-minute chart for clues from prior price action that might suggest where the dollar CAD might find support. And this is essentially the chart that I looked at. So I was looking at the rally today. This is a 5-minute chart. Again, you're basically seeing the same move I just showed you. The same move I just showed you on the 15-minute chart with the indicators, with the moving averages, that 15-minute ride to 5 scenario. This is the same move only on a 5-minute chart. I like looking at a shorter-term time frame like the 5-minute chart to glean a better sense of, where did this pair pause in the course of its previous rally. Well, you can already see the arrows in my chart. I was talking about this 1.0340-ish area. So I've got a horizontal blue line on the upper half of this chart I've actually got it at 41, but you can say it's just 40. Just make a nice round number, say 1.0340. Why there? I don't know. There was a daily M4 pivot point near there. Now maybe that was part of the contributing factor, but if you look at that rally over much of today's London session, if there was one place that hesitated at the most, and can you see why I concluded 1.0340 might be important? If there's one place that the dollar CAD in its earlier rally seemed to hesitate the most for the longest, it seemed to be around the 1.0340 area. So that was the area we talked about in terms of a prospective long. And as I proceed forward in time on this 5-minute chart, we got our dip. Dollar CAD stalls for some time around 10340-ish and eventually moves higher. Profit target for this one, we talked about 1.04, not for 2 reasons. One, it's a psychological level, and if I move that chart and minimize or reduce the width of the 15-minute chart, look at the 4-hour chart with weekly pivot points. We had a weekly M4 pivot point, a classic resistance pivot point, a prospective ceiling for the dollar CAD here. Weekly M4 pivot point just below 1.04 to psychological. In fact, essentially, you had round that up, call it 1.04. So psychological level, weekly M4, that was a viable profit target for that long. Now, was it a huge pips? No. 60 pips? But considering what the euro did during much of the New York morning session, this was a pretty decent trade. Pretty decent trade. And by the way, it was the kind of trade we've referred to in the past at FX Bootcamp as a moo trade. Are there any current or former boot campers who've heard me use that terminology before? Actually, who have heard any of the boot camp coaches use that terminology before? Haven't talked about a moo trade in a long, long, long time. The origins of that label, moo trade, came from Chief Currency Coach Wayne McDonald, who at one point, even before I became a currency coach more than 4.5 years ago, he would talk about in the case of a currency pair that would tend to run in one direction, whether it's up or down. In this case, dollar CAD was up. He would talk about in the case of an upward move on a pair like dollar CAD, you would look to buy until the cows come home. And for us currency traders, cows come home at the London close. London close roughly noon New York time. So the idea behind the trade is I'm going to expand this hourly chart with the daily pivot points. The idea behind a classic moo trade, and again, I admit we haven't seen one in quite a long time, at least I haven't noticed one, where in this case the dollar CAD rose, found temporary resistance around the daily R2 pivot point, dropped and found support at the daily M4 pivot point, and up from there. So the idea behind the moo trade was you buy at or near M4. Now myself, I don't tend to like buying at M4 just because it's M4. I like some other sort of complementary factor there. And what I showed you earlier on the 5-minute chart, we did have some evidence that M4, that 1.0340 area was respected earlier as resistance. So what was resistance earlier became support. And also didn't hurt if you have the hourly 5 EMA in the vicinity there as well at the time. But yeah, compare that move, especially the move during today's London session where the dollar CAD is rising. And actually, this is worth showing a bit of a comparison. Actually, you know what? Better yet, I've got the chart to show you. But first, before I show you the chart that I had in mind, I'm gonna show you a contrast of two pairs here. Let's show dollar CAD first. So here's a dollar CAD 15-minute chart. Again, we talked about the rise, the rally, pullback, extension. I'm going to overlay on that a euro chart. I'm sure many of you know where I'm going with this. I mean, there was just very little correlation between the two. Once we had that sharp euro sell-off, which dollar CAD didn't really correspond to. When euro USD drops, you expect dollar CAD to rise, and vice versa. But the correlation between these two pairs was extremely mixed today, very mixed today. So my point is this: while the euro USD was sort of stalled, trading almost horizontal, very stuck, the dollar CAD kept rising during today's London session. So euro USD stalled, dollar CAD rising. That tells me that either the Canadian dollar was weak, which so there's some signs that it was, or the euro was strong, or maybe both, maybe a combination of both. So I just leave the overlay chart, and I want to show you the euro CAD. So maybe you'll see where I'm going with this. We had signs of a weak Canadian dollar, signs of a strong euro. Well, I'm guessing. Actually, let's look at the longer term chart. Yeah, I'm looking at a daily chart for the euro CAD, and this is it's been one of the bigger euro CAD candles of any cover we've seen in several days. Again, I'm not saying you should have traded this euro CAD currency pair. My point is that you had that combination of forces at work today. a relatively strong euro after the early London session sell-off, and a relatively weak Canadian dollar. And that combination means up for Euro CAD. And Mike, I don't disagree. They do. It's not that the correlation between the two pairs is not that. It's not that common. But my point is this: if the dollar were primarily in control, you would see at least some degree of correlation. I mean, the Euro USD would drop and dollar CAD would rise, not in perfect synchronicity, but at least there would be a general pattern of one up, the other down, or whatever the case, vice versa. But I mean, the two were notably mixed today. What stood out to me was that again, the commodity currencies, dollar CAD up, it was Aussie USD down, and even the British pound, as I mentioned already, was on the weak side, and the Euro USD just until that spike up in the latter part of the New York morning session, Euro just didn't do a lot. For that matter, neither did pound dollar. So Michael brought up the debt problem in the U.S., and that's something to that if there's one thing tomorrow, let me go to the FX Street calendar here. Going to fxstreet.com, as many of you should know where that is. Don't recall anything on tomorrow's calendar that would be a significant factor, but I want to check in, because I could be wrong about this. I admit I don't check the calendar as much as I used to. I'll maybe once or twice at the most a day, just to keep tabs on what's coming up. But the point I've been making lately is that the standard economic reports from either the U.S. or other parts of the developed world, they just haven't been moving the market as much these days. Have not moved the market, at least have not had a lasting impact on the likes of the currency market. Okay, I've got the news calendar queued. I've got the calendar queued up for FX Street. Canadian retail sales, that's been on the move in the market. PCE for the U.S. GDP number. Second look at GDP, that's been interesting in the past. FOMC minutes, that's the one, although that's released after tomorrow's London close, that's the one that could be interesting, although, just given the type of week we have a holiday shortened trading week in the U.S., that might get overlooked. This week. But the FOMC minutes, that could provide some really interesting clues as to what's in the Fed's mind with regards to things like, could they ease policy further, especially if things in Europe get nasty. But other than that, I just don't expect a lot in the way of lasting moves, sustained strong moves in response to U.S. news. Again, folks, right or wrong, whether you like it or not, whether I like it or not, I just haven't seen a pattern, any pattern of sustained strong moves in response to U.S. news reports, like GDP, like even NFP for that matter. So I'm not so overly concerned about the news count. What I'm saying is, you want to be aware of news. You don't want to be taking an entry right before the release of most major news reports. But boy, I'll be honest with you, as many of us at FX Boot Camp see it, particularly the coaches, our London session coach Christian Stevens and I certainly seen it this way. I haven't talked with as much with the other coaches about this, but as Chris and I see it, it seems like news almost just gets in the way. Let me say it again. It's almost like news gets in the way of, or can get in the way of an otherwise good trades. What markets are moving most in response to is, as I said earlier, macro Europe. Macro issues in Europe have still been largely driving the market. But one of the exceptions may possibly is tomorrow, and maybe even the day after that, and we'll see what happens after that. Now, there's a part of me that thinks that, but this is, were talking about, if there was an automatic across the board cut that wouldn't even kick in until 2013. That's so far out in the future for the financial markets. So, on one hand, I want to say, this doesn't matter nearly as much as Italy or Spain or, the other issues going on with Europe. But then again, consider that the lack of what the lack of progress could mean amongst politicians could mean to the U.S.'s sovereign debt rating. I mean, a failure here could really prompt one of the ratings agencies to join S&P, who downgraded the U.S. back in August. And that could be what the market, at least to some extent, what the market reacted to during the latter part of today's New York morning session. That rise in the euro, maybe due at least in small part to concerns about the super committee coming to some sort of deal. Hey, Mike, actually, I did not know that. Thank you for sharing that with me. The FX Street feature with the calendar? That's very cool. I'm actually glad I learned that, because that's I could use that. So very good. But beyond that, I'm going to repeat the same story I've repeated so many times near the end of my these recent FX Street events, which is watch Europe. We've already talked about, and I've already provided some of the clues there. I watched the European bond markets, check the likes of the yields in Italy, yields in Spain. I didn't mention earlier, but it's worth mentioning, yields in France. Keep an eye on the French bond yields as well. In other words, the French 10-year bond yield. The higher that goes, the more it's a negative for the euro. I mean, eventually, anyway, you would think. Beyond that and any other developments with regards to progress or lack thereof in Europe towards some sort of final solution. For example, I mean, there's still some chatter about like a euro bonds and ideas about what to do with maybe Italy or Spain. So these things can these new ideas or these rumors or these reports about something the German finance minister said, or these other things can always pop up at any time. So you got to be in tune with that. But beyond that, the U.S. Super Committee, what I just mentioned earlier, that just might set the tone for markets for this week. So keep an eye on that. And with that concludes my scheduled time. If I've missed any questions or missed any comments that you feel I should have addressed, please post them again. I can wait a moment and check, and maybe I can give it a quick scan and see what you guys have been talking about. I addressed Damon's question earlier. Justin, yes, Bloomberg does provide bond spreads. Justin, for example, one thing I almost mentioned but didn't is the French-German 10-year. So go to Google, and I will Google French-German 10-year spread. And it's not printed right away, but usually, where is that? I usually get it one of the first things. Oh, maybe I need to add Bloomberg. There we go. Oh, yeah, first thing. Yeah, French-German 10-year spread Bloomberg. First search result. And Mike, thank you. Yeah, you posted the link earlier to all the yields in one place. I admit I like these individual pages because you get a graphic there, and I'm a very visual sort of guy, so I like the visual provided by the graphics. So yeah, Justin was asking about yield spreads. I track that as well. So you can look, for example, at the French German 10-year yield spread. And Solomon, I don't know you're still here. You ask about, is risk on, risk off similar to knowing the market sentiment? On an intraday basis, yeah, it's the risk on, risk off. It's become a simple, kind of a classic way to describe movements in really the currency markets these days. I mean, it's certainly not the way the currency markets have always moved, but these days it seems the market does move in that fashion for the most part. Again, there's risk on, and weak dollar, weak yen, risk off, strong dollar, strong yen. Again, not every day, not every session. And the correlation isn't perfect, but that's been a pretty common theme in the currency markets. But when it comes to when you say sentiment, though, when you say sentiment, I tend to think one of the first things that come to my mind when I hear sentiment is I'll think of the Commitment of Traders Report, the COT, Commitment of Traders Report provided by the CFTC. And we can have a separate discussion about that maybe at tomorrow's webinar. And I think that covers just about all the questions and comments I've seen here. Yep, that about does it. Yeah, thank you too, Erwin. Appreciate it. Even though you and many others were rather quiet, I always appreciate the commentary. And if you're just sitting back listening, taking it all in, that's all good too. That's all good too. So, folks, thank you very much for attending. Thank you very much for your attention. Thanks as always to FX Street for making this event possible and for putting up with for me for all this time, especially for putting up with my running over 5 minutes beyond my normally allotted time. I do tend to run longer because I just tend to get long-winded about some of these topics. But folks, I hope you recognize that I tend to talk about this stuff as much as I do because I find this stuff fascinating, just infinitely fascinating, and I hope that that shows through. So with that, let's wrap this up. Have a great day, folks. Have a great evening for some of you. Have a great afternoon for others, especially North and South America. And we'll do this again tomorrow. Same bat time, same bat channel. Cheers.